Why is it important for most people to have a balanced portfolio or maybe more towards bonds as they get into retirement age?
It's the volatility and risk of loss. You know, we talk about when you are in your 20s and 30s and you're investing for the first time, you've got, let's say you're 20, you want to retire at 67, you've got 47 years for your portfolio to build. If you've got a down year or go through a crisis like we did in '08, you've got decades to recover that money and be able to withdraw, right? When you get to the place where you're withdrawing from your portfolio, you want the volatility of that portfolio to be as minimal as possible. Because, like we were talking about earlier, if you're in retirement and you're not working, you're not making any more money, and expenses are increasing, and you have a down year in your portfolio, that's going to feel pretty terrible. What do I
Hmm.
have to do? Do I have to spend less now? And how do I manage that when, my grocery bill continues to go up? Do I cut down my lifestyle? You just don't have as many options. So the idea is to be more conservative because you don't have time to recover.
Got it. And that makes me want to pull up this other. Is this a good time to bring up that other chart, Kelly? The finger chart here that
Great
we
one.
the funny looking finger
Your
pointing
word,
chart here.
Pablo.
My word, the funny finger chart from the favorite fiduciary financial advisor
Finger
friend.
chart.
Kelly, what are we looking at here? This was really illuminating to me when you explained it to me.
Yeah, so this shows two investors. The blue line and the green line are two different investors. They both started with $1 million portfolio and retired at the same time. The first investor, let's see, I got my detail here so I don't say that wrong. So they both plan to withdraw $45,000 a year, adjusted every year by 3% for inflation. Over the course of retirement, the portfolios, like the whole span of retirement, the portfolios generated about the same annual returns, but at different times. So the first investor, they retired, their first 3 years in retirement are positive gains. So 25% the first year, 10% year two, 5% year three. And then they have a negative return in year four of 15%.
Hmm.
So two people start at the same time, same amount of money. Second investor, they have the negative 15% decline in the first year of retirement. And then the next 3 years, they have gains. So 5%, 10%, and 25% respectively. So after that, the same pattern of returns, but you'll see this is how long look at the bottom of those lines there. That's how many years into retirement those portfolio lasts. Two investors, exact same portfolios, similar returns, similar inflation. One retired in a down market. The other had 3 years of up markets before they encountered decline. Very different outcomes.
And that's, I think you said it, what, 4.5% withdrawals, withdrawals, I think is what that was built off of. So you could
That's right.
see how the problem would be exacerbated if you started to get more aggressive and it became 6% or 8% withdrawals. That finger, the bottom of the finger there would sway the way that you don't want it to go, which it might get closer to 10 or 20 years of retirement. Am I looking at, had my finger analysis been right there?
That's fair. Yeah.
You see, when I look at this chart and I had Kelly explain that to me, what this explains is that feeling that I kept getting, that I kept trying to put my finger on. And it's this idea that as we adopt this thing that I didn't realize how new it was, this idea that we control our own retirement and we do it through these like equities and whatnot, and we start to live longer, right? Like two paradigms have shifted in our generation for that, right? Like we're controlling our own retirement and we're living longer as well. And this timing of when you retire and counting on, like you could, for no fault of your own, you can do everything right. This investor saved $1 million, call it $4 million. You can do everything right. And to no fault of your own, because you retired and something went wrong at the time where you actually needed your money, the day that you actually needed the cash flow, your life experience can be drastically different. That's what I'm seeing in this chart, right?
Yes, absolutely. You 100% timing of the year that you retire out of your control as far as what's going to happen in the financial markets. But the traditional way of investing has that risk that's associated with it. So you have to build a plan. You have to work with professionals like Kelly. You have to be educated. You have to build a plan that prevents the risk of that potential, hurting your overall lifestyle. So you have to be conservative, right? That's why Kelly mentioned about being in assets that are less volatile as well. The biggest thing for you as you get into retirement is, how do I make sure that money lasts for me? How do I do that? And you don't know what's going to come down. We had a pandemic and the stock market dropped 30% after the pandemic. Now it quickly rebounded, but you don't know when that's going to happen. To your point, you have to plan appropriately, because something negative could happen after you retire, and it could really shift the finger the wrong way.
Yeah. And to me, that's the attractive point for me for rental properties. This is why when you tell me about army of cash flowing rental properties, and I combine that with my own beliefs around investing, which Kelly and I have talked about a whole bunch, right? Like this idea that if I want to be in control of my own destiny, having a whole bunch of rental properties that for me appreciate as good or more than any other asset that I'm going to be in, but also provide this idea that it lessens the impact of when I retire, right? Like that whole like timing thing that I don't have control of what's happening in the economy. If what I have is, call it 40 rental properties that are going to be paying me, I don't know, $20,000 a month cash flow, one or two goes vacant, my cash flow goes down to 18 grand a month. It doesn't start this like repetitive cycle of like, like tailspin.
I love that point here. I want to make one thing really clear that many people might get it twisted. All right. Yeah. When you're in traditional assets and you're talking about the return on that asset, it is based on the equity value, or it's based on the asset value there. Your return, your dividend or whatnot, your coupon, if it's a bond, is based on the asset value. In rental properties, you have an asset value. It's how much is my home worth. But the amount of your quote unquote dividend is not based on what the value of the house is worth. It's based on the rental yield. It is how much does that home rent for? And those two things are not always correlated. One example is, I started to invest in rental real estate in 2006, and I bought 40 rental properties as a 22-year-old, 23-year-old. And subsequently, I lived through the Great Recession, where the market value, the asset value, dropped 35%. But my income from the rental perspective, my quote unquote dividend, didn't change at all. It continued to go up. Yep. And so that is a very big change, and a reason why obviously I love rental property investing. It's because you can look specifically at that consistency of the rental income. And we know that nationwide, rents have never declined in the United States as long as we've been tracking them. So you have this consistency. It's really that consistency of the thing that matters the most to you when you get to retirement, consistency of income. And so not many people know that though, right? So I think all in all, encompassing that's what you're talking about, right? Yeah. You're talking about that income that's coming in. Yeah. And it's a lot more consistent, a lot less variable than other assets where generally folks have all of their money. You know what I mean?
Yeah, well, I'm conservative, right? And again, like kind of product agnostic. So I just want to get kind of add in there, rental real estate does have its risks, and you guys have been very upfront about that. There are different types of risks, but to your point, the income that you're getting from a rental is not tied to the value of the property in any given year necessarily, right? Mm-hmm. And there are things like, vacancies, but that's where I think the data comes in, being like really thoughtful. And I love the way your team puts it together, and you've got all the historical support for it. You can plan that. And just like there are ways to manage your income off a stock and bond portfolio, there are ways to manage. It's a little more stable, I think, by the nature of it, but it's a higher cost of entry, right? And if you have to come out of pocket, like I said, you have different risks, you have different expenses that you need to consider. But there are also, things that you do as a team, like thinking about the length of the lease, thinking like, so I think there, like, even if you're investing in rental real estate, there are a lot of things to think about: the quality of the property and the product, what types of renters are you going to get, the stability of the renters, and all of those things that we've talked about before kind of go into that as well.
100%. There's what I would call teammate risk. A lot more teammate risk when it comes to investing in single family rental properties. And if you don't have the right team that can support that investment to minimize maintenance and vacancy, the pain of some of those cash outflows is really painful on the real estate side, which you don't have to deal with when in some of those more traditional assets. So I really appreciate you bringing that up, Kelly, because there's not a perfect investment out there. There are some that will accommodate more towards a certain investor at their certain time in their life, and there are others that won't. I think one of the challenges, though, is many people just don't even know. They only stick to one way of doing things, and that's why I love working with you, Kelly. You're agnostic when it comes to different types of investments. You're a JWB client, which is wonderful, and so you've been able to kind of bridge that gap that most financial advisors never bridge, which is actually looking at real estate as an investment and saying, that should be a part of my portfolio.